You felt it, didn't you? That split second when silver looked ready to rip the roof off, and then bang, the floor gave way. Not because the world suddenly stopped needing silver, not because demand evaporated overnight, but because the people running the casino reached under the table and rewrote the rules while the hand was still in play. Here's what actually happened. Quick ask before we go any further. If you want clean, real-time breakdowns like this, without fluff, tap subscribe and turn on the notification bell so you don't miss the next move when it hits fast. Silver began pushing into the mid-80s. Buyers leaned in. Momentum built, and the market was seconds away from proving one thing. The paper shorts were losing control. Then an emergency notice hit the wires from the main futures exchange that dominates precious metals trading in the West. Boring to look at, dangerous to ignore. The kind of document most people scroll past, and the kind that can shift billions with a single line. Effective immediately, the exchange changed how it calculates margin for precious metals contracts. Instead of a fixed dollar amount, it switched to a percentage of the contract's notional value. For silver, that percentage landed at 9%. That sounds harmless, until you translate it into real money. With silver near $85, the cost to hold one contract jumped fast by thousands overnight. So if you were long using leverage, you got the same ultimatum the system always delivers when it gets nervous: add cash. And right on cue, the chart reacted the way it always does when the house pulls that lever. The moment the news hit the terminals, silver snapped lower, dropping from the highs to the low 83s in minutes. The red candles looked violent, ugly, and perfectly timed to manufacture fear. The headlines you'll see next will say the rally failed. They'll whisper, bubble. They'll tell you the fever broke. But here's the part you have to stare at because it changes everything. The smash didn't stick. Silver didn't collapse the way it did in past squeezes. It didn't unravel into a multi-day waterfall. It dipped, printed a long wick, and buyers stepped in like they were waiting for that exact moment. The price tried to break, and it refused. That's not weakness. That's a market with real demand underneath the paper games. So ask yourself, if the exchange fires a major weapon, raising the toll to participate, and the best it can do is knock silver down a couple bucks before it gets bought right back, what does that tell you about the force pushing the other way? It tells you the buyers showing up now aren't tourists. They're not just chart chasers. A margin hike crushes the leveraged speculator. It doesn't scare off a cash buyer who genuinely needs metal. If an industrial user needs silver for electronics, solar, medical equipment, or batteries, they don't sit there calculating margin requirements. They calculate production schedules. If the price dips, they buy more because it's cheaper input. You can't margin call a factory, and that's why this rule change is such a loud signal. When the system is confident, it lets the market breathe. When the system feels cornered, it tightens the leash. The margin hike wasn't about risk management. It was about stopping a stampede. It was about draining liquidity from the long side to force selling pressure at the exact moment silver was trying to break higher. While the exchange was scrambling to cool the paper market, something else was happening above the trading desks, something political. Reports surfaced of an urgent, unscheduled conversation among top finance officials from the most powerful Western economies. Officially, the topic was securing and diversifying supply chains for critical minerals. That phrase sounds like sleepy bureaucracy until you look at the timing. Because this didn't happen during a quiet week, it happened during a silver spike, premiums flaring, inventories draining, and the physical market showing stress. When governments suddenly say critical minerals, they're not talking about jewelry. They're talking about national security and industrial survival. They're talking about what you can't build the modern world without. And silver sits right in the middle of that list, whether the public is told or not. Think about what silver actually is in 2026. It's not just a shiny coin. It's a top-tier conductor used at scale. It's inside electronics, inside power systems, inside military hardware, embedded in the infrastructure of modern life. If supply tightens hard enough, production lines don't just get expensive, they can stop. So when you hear officials talking about securing supply, the translation is simple. They're worried the flow is breaking. When you hear diversifying, the translation is even simpler. They're worried the supply is controlled by rivals or controlled by markets they don't command. And this is where the story gets uncomfortable because it exposes the real conflict. The paper market wants control. The physical market demands metal. When those two collide, rules change. The exchange tries to cool the price with margin increases. That's the financial response. Governments talk supply chains. That's the political response. And the political response matters more because it hints at what comes next if the shortage deepens. Prioritization, allocation, rationing, soft at first, then harder. If a manufacturer needs silver to keep a grid project alive, and a defense supplier needs silver to keep systems running, and regular people want silver as a hedge against currency decay, who gets priority when supplies are tight? That question is the cliffhanger behind every boring policy meeting, and it's why you can't brush this off as just another trading day. Now let's talk about why the margin attack didn't work the way it used to. In the past, when the exchange raised margins, the market often cracked. Leverage came off, forced liquidations cascaded, and price fell far more than fundamentals would justify. The system relied on one thing, a unified global price, where paper selling in the West dragged down the whole world. But that unity is breaking. Right now, there's a widening gap between what paper claims silver is worth in Western futures and what real buyers are paying in markets that care more about delivery than leverage. When the East is willing to pay meaningfully more for physical metal, it creates a hard floor under the Western paper price. Because if the paper price gets smashed too low, arbitrage becomes irresistible. So when you hear officials talking about securing supply, the translation is simple. They're worried the flow is breaking. When you hear diversifying, the translation is even simpler. They're worried the supply is controlled by rivals or controlled by markets they don't command. Here's the mechanics. If the West pushes silver down aggressively while the East holds a higher physical bid, you create instant profit for anyone who can source metal in the West and deliver it where it's valued more. The bigger the gap, the faster metal drains. And when metal drains, the paper game gets more dangerous, because paper promises still need real inventory behind them, especially during delivery windows. That's why every smash is becoming more fragile. It can still print scary candles, it can still trigger stop losses, it can still shake out weak hands, but it also puts silver on sale for buyers who don't care about the narrative and who have the cash to take advantage. And today, the vault numbers told a story the candles can't hide. Depository reports showed meaningful withdrawals across multiple facilities, large chunks of silver leaving the system, metal that was counted, sitting there, available, and then suddenly gone. The most important category isn't just total ounces, it's the deliverable pool, the inventory that can actually satisfy immediate delivery demands. When that shrinks while price is being leaned on, the market is screaming something simple. The manipulators are losing the physical fight, so the exchange hikes margin to protect the shorts. But the lower price invites more physical buying. That physical buying pulls inventory, and tighter inventory makes the shorts even more vulnerable. It's a loop the system hates, because its own tools can start to backfire. Which brings us to the next move. If they can't stop demand, they try to limit access. And we're already seeing it in the most ordinary places. Large retailers that previously sold silver freely have started implementing purchase limits. Think about how abnormal that is. In normal capitalism, a product flying off shelves gets restocked and sold again. Limits show up when supply is constrained, restocking is uncertain, and the seller is trying to prevent a total wipeout. And then there's the mint situation. Delays, back orders, bottlenecks. People hear delay and assume it's staffing or shipping. Sometimes it is. But during a surge, delays can also be a symptom of a market trying to source enough raw material at the right price, fast enough to keep up. When demand outruns supply chains, you see, out of stock, back-ordered, allocation, limit one. That's soft rationing. It's not a law. It's not a headline. But it is the beginning of a gate closing. Now zoom back out. Put the intraday candle aside. What did the system reveal today? First, fear, because confident markets don't change rules mid-surge. Second, real demand, because real demand bought the dip immediately. Third, strain and physical flow, because inventory is moving out while paper price is being leaned on. Fourth, preparation at the highest levels, because when officials talk critical minerals during a spike, they're preparing policy. This is why today's price action isn't bearish. It's a stress test. The house tried to slam the brakes, and the car still moved forward. And here's where this becomes a decision point for you. The next phase isn't just about price, it's about availability. It's about whether the average person can still participate at reasonable premiums, or whether the metal quietly gets redirected away from public hands and into industrial and strategic channels. If you're holding physical silver, understand what you own. You're not holding a line on a screen. You're holding a scarce input to modern life. A system can push a paper price down for a day. It can't print a mine. It can't vote new ounces into existence. It can't speed up geology. And if you're not holding any, you have to ask yourself something uncomfortable. Will you wait until the market makes it obvious to everyone? Because by the time it's obvious, it's usually expensive, inconvenient, and sometimes unavailable. Now lean in, because the next part is what most people miss. When the exchange raises margin, it does create forced selling, especially among leveraged longs. That can produce sharp dips. Those dips can look like the end. And if you only watch the screen, you'll be tempted to believe it. But the real story is written in behavior. Who buys the dip? How fast does price recover? Do premiums fall with the paper price, or do they stay elevated? Do inventories refill, or do they keep draining? Do delivery dynamics calm down, or do more players fight to stay close to the front month? Those are the questions that tell you if the rally is fragile or unstoppable. And today's behavior was defiant. A punitive margin increase hit, a sharp dip printed, and buyers treated it like a gift. So what's next? If paper tools can't kill the move, the system will keep escalating in the areas it can control. Leverage, access, narrative, more warnings, more expert takes, more attempts to label every dip as the top. More reasons you're supposed to feel foolish for wanting metal. Because here's the truth. If silver is becoming critical again, the last thing powerful institutions want is a public that understands that early. They prefer you distracted. They prefer you in paper products you can't redeem. They prefer you staring at a chart and believing the chart is the whole story. Meanwhile, the people with real need and real money keep pulling metal out of the system. Now let's bring it home with a simple, brutally clear takeaway. Today wasn't about a $2 move. Today was about control. The rule change wasn't random. It wasn't routine. It was timed. It was aimed. It was meant to send a message. We can still hit the price whenever we want. But the market sent a message back. Not like you used to. That's why this moment matters. When the old playbook stops working, the next chapters get wild, because the system has fewer tools than it pretends, and the tools it has come with consequences. If they smash price too hard, they accelerate physical drainage. If they let price rise, they expose the shorts and invite more demand. If they restrict access, they confirm the shortage and trigger even more panic buying. Every path has a cost. So here's my question for you. Do you think today's margin move was a one-time risk adjustment, or the opening shot of a longer campaign to slow this market down? And second, be honest. If you saw silver rip toward $100 and retailers started limiting purchases everywhere, would you wish you acted when it was still easy? Drop your thoughts in the comments because I read them, and the patterns you're seeing on the ground matter more than 1,000 headlines. If you want updates like this, clear, fast, and no fluff, make sure you're subscribed here. And if you're getting value from these breakdowns, help me out by hitting subscribe and turning on all notifications. So when the next rule change drops, you hear it the minute it hits the wire, because the empire tried to strike back today. The dip got bought. The vaults kept bleeding. The policy people started meeting. And the biggest clue of all is sitting right there on your screen. After everything they threw at it, silver refused to die. And keep your eye on the futures curve, because it often whispers the truth before the headlines do. In a calm market, future months trade at a premium to spot, because storage, insurance, and financing cost something. But when metal is scarce right now, that relationship can flip. Spot gets bid up, near-month contracts get tight, and suddenly the market starts paying you to take delivery sooner. That's not speculation. That's a warning light that the physical pipeline is stressed. Watch delivery behavior too. When a contract month approaches expiration, most traders normally roll forward without drama. But when confidence breaks, some players refuse to roll. They want the front month. They want bars. They don't want a promise. And if enough players do that at the same time, the exchange faces a nightmare. It must either source metal at any price or find a way to change the settlement terms. That's the cliffhanger nobody wants to say out loud. Higher margins are step one. Limits at retailers are step two. The next steps get uglier. Position caps, tighter definitions of deliverable inventory, and louder encouragement to cash settle. So don't just watch price. Watch the rules, the premiums, and the waiting list too. When the rules start changing mid-game and physical silver keeps leaving the vaults, what do you think breaks first? Price discovery or public access? Let me know in the comments below.